higher interest rates are on everyone's minds. And of course, the geopolitical risks that is out there, everyone knows about, but you really try to balance that out. But the stock market is really not digesting it that well. And technically, Derek, we moved under the 200-day moving average, and that is something we pay attention to. But more importantly, as Danny points out, interest rates are higher.
No, the stock market wants to go to a party, but the bond market won't get in the car.
There you go. So you talk about higher interest rates, and of course that has an effect on valuations across everything from equities to debt to even real estate. But we are in this season right now, Danny, that it's good seasonality. As we get into the fourth quarter, generally, historically, the market does better. Part of that is that earnings are coming out, and the comparisons, Derek, are going to get easier than what we've seen before.
Right. This year, the forecasts are for flat earnings on a year-over-year basis. Next quarter, they're supposed to accelerate almost to double-digit levels, and likewise in 2024. So the valuation of the market has improved as the weakness we've seen persists.
And you talk about really seasonality in earnings, and we really look across a number of sectors, and one of those sectors, not surprisingly, that is doing well is energy. And part of that is because of the geopolitical uncertainty, especially with what is happening in Israel, because Iran's involvement is really kind of key to this. If they get involved and they choke off the Straits of Hormuz, that could make oil prices go even higher than the $90 a barrel we saw this week.
Right, and the other reason we've held energy tactically in our portfolios is we believe that the lack of capex over the last decade. So really the price increase is more about lack of supply than lack of demand. And if that exacerbates, then you're going to see incredible earnings from the oil companies. The comparisons next year are very easy. They're going to contribute a lot to that S&P earnings growth that's forecasted for 2024.
Yeah, so we're going to get to GDP, but I just wanted to go out there and let people know that we look at oil production and really what's happening in the United States. This is a surprising fact that we are larger than Saudi Arabia. We are exporting 4 million barrels a day. And what that does, that lowers the trade deficit, which is kind of helping a lot of things across the interest rate market and the U.S. dollar. But for sure, we still have to start talking about inflation and GDP. That topic is not going away. And of course, you mentioned GDP, still positive.
Right. Well, the forecast for third quarter GDP are anywhere from 4 to 5%. The Atlanta Fed is actually at 5.7%, which is, I think, why the companies that have reported thus far have beaten estimates by a wide margin.
Of course, in the GDP, it looks positive. Inflation is trying to get to the Fed's target, is going to be a bumpy ride, Danny. There's just no doubt about that. We look at what is coming down the pike, and of course, it is getting better. You'll remember, Danny, that a year ago, inflation was as high as 9%. It has trended down, no doubt about it. But there's these things that continue to go in there. Those are wages and energy prices. Those are still putting pressure on the inflation expectations.
How's our old buddy, the wall of worry?
Yeah, the wall of worry is still there. It's still being built up on. You just can't get away, of course, from the big two stories. One is Treasury yields continuing to go up. And number two, geopolitical risks around the world obviously are very high, not only in, of course, the Israel situation, but still Ukraine and Russia is still at the top of the conversation. And we saw that, Derek, this week with the president asking for more money.
Right, and that's, again, would that lead to more issuance, which would be further upward pressure on interest rates? I mean, the Treasury market, the drawdown the Treasury market has seen over the last couple of years is the largest on record. And it's going to be a problem for the government if these short-term rates don't start to go down, because it's got to refinance the debt.
That's right. And you talk about the debt that's out there right now, and of course, the trillions of dollars, $33.5 trillion in debt. Danny, that is not going away. And of course, when those bonds come due, they're going to have to renew them at higher interest rates.